folks. It's Dave Burrows. I am Chief Investment Officer here at Barometer Capital Management, and I want to thank everybody for joining on. Every week, we seem to have a great mix of clients and friends of the firm and some interested parties who have decided to join in the discussion. What I'm going to do today is just quickly kind of come from a top-down perspective. We're going to talk a little bit about what's been going on over the last couple of weeks, lots to talk about there. And then try and put it into context in the big picture and what it means to us in our portfolios, what we're doing to make changes, what stays the same. We are here in the middle of August, and as is usual, it's about the least liquid point in the year. Lots of folks are away. Moves can be exacerbated because there's not as much liquidity. So I've asked Diana Avidor to jump on the call with us today to talk a little bit about some of the trading dynamics. I also asked James Callahan to come on. James is one of our key bottom-up portfolio managers, stock pickers, to talk a little bit about some small positioning changes that we've made. And hopefully it'll be a useful discussion. So just as always, we're going to take questions at the end. Please don't hesitate to throw questions into the question box. I'll do my very best to navigate through them and see if we can answer as many as possible. And don't be shy. Just quickly off the top, we think we started a structural bull market in equities originally in the US in 2013. We've been working our way higher since then. These are the last two bull markets, the 80s and 90s. The structural bear market from 2000 to 2013, which included the financial crisis and the tech wreck, things we'd prefer not to see again anytime soon. It went on 150 months, so 12 years. And then the bull market we've been in since 2013 with interruptions. And as I like to point out, in a structural bull market, it tends to be that you stay above a rising 200-week moving average. Doesn't mean you don't get tested. It doesn't mean you don't have wobbles. But once you come out of a cyclical bear market, it tends to be you get 2 to 3 years of pretty low volatility, and it never feels like it's going to happen because there's always lots of bad news to consider and people have had their confidence shaken. We exited this most recent cyclical bear market in January. We've been working our way higher since then. Had a little pullback in April. We had a little pullback this month. So here we are halfway through August. On the month, the S&P is down 1.84%, but it's been a little bit more than that. When we look at it under a microscope, market started to pull back the very beginning of July on some weaker economic data. And then, of course, last week, we had these 2 sharp days down following some moves in the currency markets. So at the worst point, the S&P was off 9.7%, broke below the 50-day. So in fact, below the 8-day, the 21-day, and the 50-day moving average. Has held so far above the 200-day moving average, which is a great long-term measure of trend. And we've bounced. Now, there was 2 gaps on the chart. One is we broke the 50-day, and one 2 days later. And since then, we've had a nice bounce. So what's happened? Well, we've bounced about 50% of what was given up. The S&P, as of, 20 minutes ago, was down about 5% off the highs. We continue to be below the 50-day moving average. So a short-term measure of trend would say we still haven't recaptured. We have recaptured these 2 gaps on the chart, which tends to happen. Frankly, the sooner that you recapture gaps on a chart, the better. But now we're at sort of an ambiguous spot. If we look at the NASDAQ 100, you can see the biggest source of the selling was tech. NASDAQ 100 at the worst point was down 16% and just below the 200-day moving average. Quite quickly reversed back above. And to just go through the order of events, we were in this channel. We had what we call a throwover, where the market accelerated up and above trend. That often is an exhaustion move in the short term, and very quickly reversed down into the trend and down to the other side. So we've bounced, we have filled some gaps, but we're just below this key channel. Again, it's rallied about a third back. It's down about 10% off the highs. And so this remains one of the more questionable parts of the market, and we'll see whether it can recapture. Now, big part of the issue last week was this reversal up in the value of the yen versus the dollar. Been a very solid downtrend as the yen was weakening due to their very low interest rates, differential versus the rest of the world, and the fact that they've in general had relatively low inflation. Inflation has been picking up. They had the first rate hike, which was a surprise. The yen spiked higher, and as we talked about last week, caused quite a furious covering of short yen positions and a repatriation of yen back to Japan and a selling of assets. So the first thing that happened was in the night last Monday, there was a big sell-off in the Nikkei. In fact, over 2 days, it was down 27%. But you can see very quickly we've rallied back. Now we stayed above all the moving averages and now just a few percent off the highs. Interesting, Warren Buffett, on the day that the market cracked, sold a large issue of Japanese yen bonds to buy Japanese stocks. In fact, lots of folks stepped in to buy Japanese stocks, but I think private investors in general were shaken by that. When the U.S. market opened that morning, there was a round of selling in U.S. markets. And the question is, has the weakness in the S&P been driven by weaker economic data? Or was it largely a technical factor at an illiquid time of the year that there was large selling in the Japanese yen carry trade? By most measures, people believe a lot of the Japanese yen carry trade may have been covered, but that remains to be seen. So Diane, I thought maybe you could talk a little bit about some of the things that we've been watching, because there are some sellers who aren't selling because they think there's big fundamental change. They're driven by market action. Maybe you could talk a little bit about that.
That's right. Hello, everybody. Well, bottom line, traders in the last couple of weeks have been very concerned and watching to see what was the trigger of the big sell-off. You don't always wake up in the morning and see a country's stock market down 12.4%. So whether it's slowing economic growth or something more technical than that, and given what the markets have done coming back, whether it's volatility or the S&P or NASDAQ or even Japan and the yen, the way it has come back, it's given me reason to think that bottom line, I maintain that last week's violent sell-off was triggered ultimately by the quick strength in the yen, that so far weaker data, soft landing numbers, you see people are being surveyed, everything is holding up well. Flow-wise and seasonally, August tends to be a little unpredictable, and the recent volatility is no small way a consequence of a large one-sided trade gone wrong and lots to do with market structure in the quantitative trading community. The chart that you're seeing in front of you are this one part of the quantitative community, and flow information from major brokers and prime brokers point to a huge flow mismatch. In other words, there was lots of selling to do because of some systematic reasons into an illiquid environment, and that just kind of toppled the apple cart a little bit. I believe I would call it a little bit of an accident. Goldman Sachs noted that while we tally up the pieces of fragmented information, be it Bank of Japan raising rates and the yen doing what it did, it kind of spilled over North America, the market saw the most selling since April during the beginning of last week, only to report that by the end of the week, they saw the largest net buying in global equities the whole year. So there was lots of belief in the economy's slowdown, but not quite a recession, strong recession. And people, like you mentioned, Dave, Warren Buffett actually threw money at the market. Overall, the feeling is that total exposure has actually overshot to the downside. So that was covered a little bit. CTA supply was almost $81 billion over, 48 hours. That's a lot of dollars to absorb.
Now,
And they are
Diana,
now pretty underway.
those flows are driven by in the CTA community rules around how much exposure they can have based on how much volatility there is in the market. And so when volatility picks up, it's not like they have a choice. The risk manager taps them on the shoulder and says, you got to take some of this money out of the market. And maybe talk a little bit about this VIX chart.
Yeah, so that is the volatility chart. And as you can see, it has really spiked up that 24-hour period. That means that when that risk manager, to your point, comes tapping on the shoulder, it means you have to take your nets down and your gross down, and you must just take your exposure down because it's a mathematical calculation of where you're allowed to be. And so whether you like it or not, you go out to sell. And, actually, talking about that, there's something we call at the touch, what you can sell at the price on the screen. And given where we are in August, where everybody's away, that's down about 80%. So generally, just by example, in the US, you can pretty much move around $26 billion. $26 million at the touch, at the price that you see. It's now 5 million. So it has gone down substantially. So you need to move the price if you want to move more money. So
So
that
this wave
creates a
of selling,
cascade. That's right. It cascades the price
right?
in a much bigger fashion.
Right.
So that's about volatility.
Interesting, Diana. Just compare this spike in VIX that we just saw to the spike in VIX in early 2020. Compare and contrast those a little bit.
Right. So there was COVID. And everything was closing down. And when you look at, if you think of 9/11, or if you think of long-term credit, all these events are crisis events. We did not have a crisis event in this case.
I think, Diane, I think one of the best data points I can look at is you see this COVID spike and look at the amount of bouncing around at high levels it did for months and months before coming down into a normal range.
Right.
Same thing in the financial crisis. You had this spike in volatility, and then these are all monthly bars before it came back down. This is the tech wreck, and this is the 1998 Asian currency crisis. In contrast, we had this spike in VIX in an illiquid market, but look, VIX is already back down in this normal sort of bull market range. So I do take some information from that, and especially when you look at what happened in the U.S. dollar. U.S. dollar strengthened through the bear market in 2022. That was people seeking safety, and topped when the market had its low. And then each of these other spikes happened at equity market lows. This was the little bounce in the US dollar when we got the yen spike. But look, the US dollar is already backing off. So the fact that the US dollar really is at multi-month lows tells you there's not a lot of safe haven focus in hot money. In fact, this is actually supportive of risk assets. To have the US dollar backing off like that tends to be good for global stocks and materials and lots of sort of risk-oriented assets.
And it also points to this recession narrative. Yields really sold down prior to this event, and yields are higher than where they were 2 weeks ago. Would have been supportive of the dollar otherwise, but it just actually points to no crisis. Otherwise, the US dollar would have been more of a haven.
So Diana, here's the near-term picture of the S&P, and maybe you can talk a little bit about this price movement. This was the first gap down. This was the second gap down on the Jap.
Yeah.
So this was on weaker data, and then this was on the Japanese shock. And we've traveled up, we filled this gap. We've just about filled this gap as of today, but we're still below the 50-day moving average. Do you see any clarity in that, or is it still a little bit ambiguous?
So given the amount of dollars that have gone through, given the seasonality, given the fact that we have a few big catalysts coming up, which are risk, that's the CPI, we have Jackson Hole at the end of the month, and we have Nvidia earnings on the 28th of August. Markets watching this very carefully, and remember, it's very illiquid. The technicals on that chart point to perhaps a little bit of back and forth. I see the month as being without any major skew. I see the market for the rest of the month as probably just back and forth. On the scale of 1 to 10, from a flow perspective, we've had some very big inflows coming in, but from the trading community, I think that we're probably at 8 out of 10. So it's possible that there is a little remnants back and forth of portfolio cleanup to do into an illiquid environment. So this is a resistance period, and we need to see some more data points to, and we need the chart to work through the resistance, if it will.
So just from a pure chart perspective, it's not impossible that we get a V bottom here. It's also not impossible that over the next, couple of weeks, you have a little bit of back and forth and you test this lower area. So as a result, we have done nothing as far as buying goes in the last week, because it's still ambiguous. So we'll talk through some of that data. I'm just going to jump on to earnings, the key sort of fundamental things that are moving the market. We're most of the way through the earnings season. 455 companies have reported at a 500. Average company had sales growth of about 5%. Earnings growth, which we talked about over the last few webcasts, as expecting about 9%, and we got about 9% earnings growth. Some sectors a little better, some sectors a little worse. But in fact, actually, the market treated better earnings better than it has in recent quarters. So that was, I would stock the earnings period as being a positive. When we look at earnings revisions, this has been the historical trend of revisions over the course of the quarter. And so when you got 60 days out from the end of the quarter, in general, you'd had big revisions down, a little bit better into the quarter, and then sort of flat. This is this quarter's revisions. They've actually been quite a lot better than what would be typical, and not quite as good as they were in the first quarter, but still quite good. And when we look at revisions for next year, in fact, revisions have been going higher and flat over the last couple of weeks. So no sign of fundamental weakness coming from the analyst community. The economic data has been weaker. ISM Manufacturing data a little bit worse. ISM Services showing some slowing. The average weekly hours, has been coming down a little bit, and the jobless claims up a little bit. So that is something that people are talking about. Now, really, it shouldn't be a surprise. We've been through a tightening cycle, and the Fed has been trying to cool these things down. When we look at CPI and core PCE, it's been coming down as well. So look, this is what the Fed's been trying to do. The question is, does recent data point more towards a hard landing, or does it continue to point a soft landing? And not that the survey of global fund managers gets it right all the time, but it is interesting that as of the August survey, this has just came out, we've gone from 68% of respondents expecting a soft landing to 76% of respondents expecting a hard landing. So a slight uptick in the hard landing camp at 13%, which is almost nothing. So no landing, at 3%. So this is kind of what we want to see. We'd like to see a slowdown. We'd like to see a slowdown in inflation, and we would like to see the Fed come in with liquidity. So what do I take away from all of this? Well, we've talked a little bit about the equally weighted S&P, the average stock. I would suggest that the movement in the S&P and the NASDAQ was skewed by the sell-off in the very biggest stocks, which we've pointed to over the last number of months as a possibility, which is why we were underweight. I think it's interesting, the equally weighted S&P as of, I don't know, 3 o'clock this afternoon, down 2.9% off the high. That's not something I'm overly worried about. We've come out of this consolidation, we're above it. That's positive. We're just slightly off the market highs. I think that's a positive. In Canada, as of last week, we were highlighting that the market had broken out and was coming back and testing the breakout. Well, here we are a week later. We've recaptured almost all of what was given up. Market's 2% off the highs. So TSX actually, the Canadian market, looks quite interesting. And we talked about the reason why: heavy makeup in financials and industrials and energy, which all are sectors that we have liked. And it is proving to be more resilient recently than the S&P. And we think that's positive because it's a fairly economically sensitive market. On fixed income, we saw the generational low in 2020. We've talked about the rise in higher lows and higher highs in rates. Last week we talked about this being a sort of an important level. It did dip below, but rates quickly came back above that level. So in general, I would say things are a little bit better in fixed income world. At the worst point, the TLT was off 53%. As we sit today, that's bounced about 8% since October. So bonds are a little bit better. The total return on the TLT, I think, since October is about 12%. But as we've said, lower rates should actually be good for stocks. And they have been. Stocks versus bonds continuing to outperform. And if we actually take from the October lows and rates, the aggregate bond index up 10%, the S&P up 26%. The dividend growth ETF, which is a lower risk equity index, up 24%. So we've been focused on dividend growth in a world where we think rising cost of living demands a rising stream of income. Things are playing out kind of as we had hoped. From a commodities perspective, we continue to be above all the long-term moving averages. We continue to be in a market where we're seeing higher highs and higher lows. We think that that's positive. Gold had a great week this week. Gold is now up 36% from the beginning of the year. Funny thing for an asset that most people seem to hate. We highlighted this very positive technical price formation called a cup and handle. We've now had 1, 2, 3, 4, 5, 6 months higher straight. And when we look at the template for the last bull market, yes, we're up 35% over the last few months, but in the last bull market, gold was up 350% over the course of a number of years, 2005 through 2011. So we do think we've embarked in a new bull market in precious metals. In general, it's been driven by central banks. It's not been driven by individual investors, certainly, and even institutions who in some cases think it's too small an asset to be interested in. But I do find it interesting. Copper has been a little bit disappointing from a commodity perspective. It has backed right down to the long-term trend line. So that's caused a little weakness in the stocks. Now, if I take the lens further back, it's actually a pretty bullish picture. Long consolidation, tightening wedge breakout, and pull back to the moving averages. We'll have to see. But this has been respecting the fact that some of the economic data has been a little weaker, certainly in China. I continue to highlight this. Gold relative to the NASDAQ 100, did make a turn in 2001 and then outperformed for a long time. It has made a turn recently. We'll see whether that follows on. That certainly would be a contrarian picture. So something just for us to watch. We don't need to spend a lot of time talking about additional economic data, but I do want to focus on what's working, right? Our strategy is all about making sure that we're focused in areas that are being revalued by the market, where we may not only get earnings growth, but we get multiple expansion. And that certainly isn't going to be every sector all the time. Our active share or the amount that we deviate from the indexes makeup is quite significant. And that's because we spend a lot of time trying to understand which neighborhoods to focus in, asset classes and sectors. Currently, that includes commodities and equities. And then within the sectors, there's some sectors that are working and some that are not. Our security selection process that James and his team are focused on are aimed at taking our investable universe and finding companies that not only have improving and in some cases accelerating fundamentals, but where price is behaving the way that it should be given what we think we know. And we're driven at the macro level by trying to find areas of the market that are showing expanding breadth, where more and more securities are participating in the rally. That's healthy. When we see deterioration in breadth, often it's the weakest securities selling off first. The leaders generally look pretty good until they don't. And so we're always focused on making sure we've got risk management around our stop losses. When breadth starts to deteriorate in a sector, we stop adding any new positions. We tighten up the stops on the positions we do have. And if we get stopped out, we don't add anything new until at the sector level, we start to see improving breadth. Same at the market level. So last week, it was a bit of a red picture. This was right after the Japan sell-off. All of our short-term indicators and long-term indicators had been affected. If we fast forward a week, well, it's a little bit better. The long-term indicator in Canada is positive, and short-term indicators as well. That's about the best. In the US, whether you're looking at the NYSE or the NASDAQ or the broad market, the percent of stocks in uptrends is sitting at around 40%. That was down about 10% over the course of the week. So it doesn't mean everything broke down. It means 10% of stocks broke down. And until we start to see that improve, we don't put new money to work. Percent of stocks trading above the 50-day moving average improved over the week. Percent of stocks trading above the 150-day moving average improved over the week. So 2 of the 4 short-term indicators, we're watching these 2% of stocks making new highs versus new lows, and the percent of stocks with positive weekly price momentum. So not enough to cause us to start putting some of the cash that we have back to work. Certainly we're watching and we're doing our research. What are we doing? We're trying to identify the sectors that have held up better than the market and shown more resilience, right? Strength in the face of weakness. And then at the company level, again, looking for companies that have behaved differently than their sectors or their groups, where clearly there are some real, people with conviction happy to stand in against weakness. And we find weak periods in the market really useful to help narrow down the list of securities we want to focus our attention on. So from a leadership perspective, financials, which has been our biggest weight, again, this is the very long-term picture, 2007 through 2021, these are monthly bars, financials are down 3% off the highs. So S&P is down 5, NASDAQ's down 10, financials down 3.8%. We actually recouped 50% of what was given up through the selling last week. I think that's really, really positive. That's a very positive chart, whether you're looking at the insurance companies or whether you're looking at some of the trading companies like Goldman Sachs, et cetera, or some of the large banks. They act very, very well, and they should in the kind of environment that we're in. Industrials sold off sharply when the market sold off and bounced sharply. So strength right away. We're down about, actually this shows 4.5%, but in fact the chart point's higher, so probably down 3.8% off the highs, about the same as financials. Again, very positive picture. This is an equally weighted of industrial companies. That includes everything. Transports, which have been a little bit weak, and certainly it includes the defense stocks. Defense stocks are down 1.5% for obvious reasons, acting better than the rest. Machinery in general acting pretty well. Again, this sector should not be performing well if we think we are headed to a hard landing. The market is telling us that things are acting pretty well. Materials are off about 4% from the highs. Again, broke out of this area of consolidation to the upside, pulled back a little over the last 2 weeks, quick to bounce, down 4%. I'd say that's a win, better than the S&P. This is a sector that typically is much more volatile than the S&P. I think that's showing resilience. Some of the companies in the group, we own Kinross and Agnico, they're frankly trading at new highs. Agnico trading better than 96% of all the companies in the S&P over the course of the year. It's been a very strong performer. Energy is broadly in this consolidation that it's in. In fact, it's off about 4% from the highs. Think that's behaving pretty well. Oil traded back up to $80 a barrel, and part of that's geopolitical, and part of it probably is mergers and acquisitions. In the Canadian market, a couple of very large M&A transactions took place. But if I look at the leaders, Imperial Oil here in Canada, closing tonight at a new all-time high, and has been marking its way higher after coming out of the bear market. It was in from 2008 to 2021. It's hard to fight companies that are returning 20% dividend growth and buying back shares aggressively based on the fact that they're generating so much free cash flow. And this is what happened in the last structural bull market. So this is sort of one I'd put in the must-own camp. Healthcare has been a lower weight for us, but we've been very targeted. Lilly, look at how resilient this was, right? Off the weakness, right back towards the highs. I'd say that's really important, trading better than 94% of companies in the S&P. The utilities that started to firm up in the spring, probably because the market was looking at some lower bond yields, have way outperformed the bond market. This is the XLU ETF. Largest holdings in here, NextEra and Southern Company. Those are the two biggest holdings that we have in the sector, and trading just off the weekly highs. Real estate investment trusts, also very interest rate sensitive. We talked about adding these about a month ago, and certainly trading well. In specific, in our macro strategy, we own a residential, multi-residential REIT, which started to perform well actually in March, about 2 months before the sector bottomed. So we're always looking for strength in the face of weakness. And this is one area of the REITs that is acting better than the rest. So we'll see. Long term, if you get higher rates, real estate doesn't tend to do well, but we're into a period where cyclically probably rates are coming down a little bit. And this helps these more defensive sectors. Technology has been a little bit more problematic. We've highlighted this waning relative strength. We had quite a move down in the XLK to below the 200-day moving average. It's had a nice bounce up, but still about 15% off the highs. If we look at the semiconductor index, as of last week, was down 28%, got as low as down 28%. We've bounced, we're still down about 17% off the highs. We filled this gap. The question is whether these things can get going again or not. We'll see. But when we look at a basket, for instance, of artificial intelligence companies, the relative strength certainly has waned a little bit. So we've been underweight technology now for several months. In the consumer in general hasn't been doing very well outside of some of the better priced retailers. Costco has been a core position for us, very quick to bounce back towards the highs. Dollarama, same thing. We've highlighted these a few times. But the consumer discretionary sector relative strength has been weak. So lots of weak performance there. We'll see whether that can shift. Had a better day today on the back of the news that the CEO of Chipotle has made a move to Starbucks. Starbucks had a good day after being very weak all year long. For us, the biggest disappointment over the last 2 weeks was Amazon. This had been a company that had been hanging in really well. It made a 5-year new high in June, but broke the 200-day moving average, and some of the relative performance here has come out. So that's a disappointment. So what does it all mean? Well, our financial weight continues to be substantial. It's just about twice the S&P weight. Energy has been continuing to move up, frankly, because it's performing well. Industrials are a significant overweight. Technology came down over the course of the week, and we talked a little bit about Nvidia. I'm going to have James Callahan come on in a moment. Our cash position is about where it was last week. No additional stop outs other than what happened at the beginning of the week last week. We did come down in our materials weight slightly. That's risk management. Even though it looks like the long-term copper chart looks good, the Freeport-McMoRan chart, came down more than we're comfortable holding. We have to follow our stop losses. Healthcare is an underweight. Communications an underweight. Consumer discretionary is a very small weight. Real estate's an underweight. So pretty focused in a few groups, and those groups, I think, continue to act very well. So just to come on for a few moments, James Callahan is going to talk a little bit about some of the portfolio activity over the course of the week, and touch on a couple of high points.
Thanks, Dave. Yeah, I'm happy to do that. So yeah, as you mentioned, we did sell our Nvidia last week. it's rallied a bit since we've sold it. That's okay. We're going to stick to our process here. The stock had been trading uncharacteristically poorly over the last month. We have trimmed that name as it's rallied. We did sell a third of our position as recently as the 19th of July. And then with reports that their new data center chip for AI, they were having some manufacturing issues. Deliveries were going to be delayed. So we just stepped to the sidelines for now. And it really is the first blemish on the name since we first bought it in January of 2023. So we're on the sidelines for now, but I would expect to see it back in portfolios in the coming months. By no means is the story derailed. It's just some short-term opacity and in deliveries of those chips that are causing us to step to the sidelines. So with the earnings report coming at the end of August, I worry a bit about that, just given the delivery delays against incredibly high expectations. Expectations as high as I've ever seen for earnings reports, and expectations for management to give blowout guidance. There's a good possibility that we don't get it this quarter, so we'll have to see. We've talked about it many times on these calls over the years. We made great money on the stock since we first bought it in client accounts in January of 23 at about $19 adjusted for the 10-to-1 split they did. We saw over 425% appreciation in the share price. The company grew revenue about 375%. They grew EBITDA 800% and free cash flows about 700% over the year and 3 quarters that we've owned it. So
Great call, James.
Thank you. And to say we've sold the name now, it's not meant to be some big call. It's just proper portfolio management here, and I would say to the listeners, expect to see it in portfolios again someday. We're just going to stick to our process. Some other notable sales we made, as you mentioned, Dave, Amazon. So we sold that after they reported earnings. AWS, the cloud business, met expectations, slightly beat, but they did see some good weakness in their core business, levered to the consumer. And they guided decently below expectations for the core business. So the stock sold off pretty sharply on the day rather than wait around. We were in an environment then that we did want to raise some cash. So we stepped to the sidelines just as part of a desire to hold a bit more cash. And then, as you said on the Freeport, as goes copper, so goes Freeport. Really, since May, copper pricing has been weaker. And as you say, pulled back to the long-term trend line. Generally, with a name like Freeport, we're willing to give it a longer leash just because a lot of the commodity producers tend to mean revert over time. But in this case, we just looked at the names portfolios held and saw Freeport as one of the weaker looking names, and so we preferred to hold cash.
I think it's important, to just highlight this. Part of what we do here is we have discipline around the exit. By the time it comes to sell a company, you always fundamentally think it's a good business, and that you could always find a reason to hold on to it. But things go wrong, and sometimes it's driven by the market, sometimes driven by the sector, or sometimes it's driven by the stock. It's important to remember there's absolutely no reason why any of these 3 couldn't wind up back in the portfolio should the sector work become more positive, should the market breadth backdrop become more positive, should the chart repair, should the fundamental data continue to get better. But it's really important, we think, to have risk management, and I'm frankly very happy to have 7.5% of the average account with some cash, because we're in the middle of August. There is some uncertainty, there is some geopolitical risk. Not a terrible thing to have flexibility, especially when the rest of the portfolio is hanging in as well as it is. Just quickly, James, can you touch on Lilly?
Yeah, happy to. So the theme with Lilly continues. They reported a blowout quarter. I don't have the growth numbers in front of me, but the revenue growth they've seen in their 2 product lines now, both the GLP-1 drugs, Mounjaro and Zepbound, just continue to blow investors away. The growth is really astonishing, and they continue to be the leader in the space. As we've said over the months, the Eli Lilly drugs are the most effective of the GLP-1 drugs on the market. They're more effective than the Novo Nordisk drugs, studies show. So consumers are gravitating more and more towards the Eli Lilly products, and they're getting some good efficaciousness, and people are losing weight. And so
we sure love seeing stocks hold up better than the market in a decline and rally more aggressively when the market bounces, that's always a good sign for going forward. So just as a highlight, you know, to put a point on it, portfolios that structure right now, I think that our average PE is about 25% below the market's PE. Our dividend growth across the firm is 43% higher than the S&P's dividend growth. And from a size perspective, as we talked about in the last few weeks, we now have a portfolio that is significantly smaller in market cap than the S&P, believing that we have some real good opportunities in sort of the mid cap area, which we talked about a few weeks ago. So, you know, some important differentiating factors. We look nothing like the S&P and would be surprised if we ever frankly did. So just to kind of wrap up, you know, volatility is now back down in a range that is a much more comfortable range. It tends to be commensurate with a cyclical bull market. Very quickly came back down into the range. You know, credit spreads we're watching. The weakest credit is seeing some elevation. So there, you know, with the tighter financial conditions, there is a little bit of concern against the weakest credit. The companies we own tend to be very big cash generators. Most of them don't have any debt. So we're not so concerned for ourselves, but it's something that we watch for the market. And we do have to remember that we're into a liquidity cycle, and we expect to see the first cut by the Fed in September, and the rest of central banks around the world are sort of on that program outside of Japan. So what does it all mean? We're still in a cyclical bull market, in a long-term secular bull market. We're about 7 months into something that will likely last, you know, 24 to 36 months. Market looks to be quite resilient. Maybe we bounce around a little bit in August, and we'll wait and see our breadth data get better before we start putting more money back to work. But the holdings that we have, we're very comfortable with, and have performed quite well in this most recent test. Things get worse, we'll raise cash. And our history has been, if things get sloppy, as you can see, we do sell positions, even if sometimes they're some of our favorite positions. But it's good to have flexibility. It's good to have an ability to put new money to work when the market shows us some really outlier behavior. And so with that, maybe I'll take some questions. Please don't hesitate to follow us on at Barometer CA. I post quite regularly, so often 4 or 5 things a day if you care. And also, you know, don't hesitate to reach out to us. So I'm just going to quickly look at the questions that we've got. So let's just take a look. Which tech firms do we continue to hold? James, are you still on?
I am.
Certainly
And I have a
Broadcom is one
list.
of our positions. Do you want to just talk a little bit about what we're still long?
Yes, I'm happy to. So in the US, we have Apple, Broadcom, Microsoft, and Motorola Solutions. Across different portfolios, of course, you know, some viewers may not see those in their accounts, but it's all just part of portfolio construction. So we hold those names. They're booked as communications, but we also own Meta and Google as well. And then in Canada, we own Constellation.
Well, that Motorola Solutions been a rocket.
It's been pristine.
Maybe we'll talk about that next week.
Yeah,
that's been a great holding. It's certainly hanging in very, very well. Got a question. Assuming you were stopped out of Cameco, yes, we did get stopped out of Cameco. I think in June, the uranium stocks certainly pulled back a little bit tighter. A question here on private equity firms, and are we in any of the private equity firms? We really have not been. You know, I think that there are going to be some issues around private equity. There's a lot of vintage funds that are coming up for liquidity, and we'll see how that all goes in a little bit tighter liquidity environment. So we have stayed away from the private equity companies. Let's take a look. Just going back to that, the question was that they have had excellent results over 1, 3, 5, and 10-year periods. And do we like these businesses? Remember that a lot of private equity has been driven by cheap capital. right? The ability to borrow for almost nothing. So use leverage to buy a business, add some more leverage, get a good financial return. When the cost of capital goes up, the ability to generate a return goes down. So we don't think that the environment we moved into in 2020 is long-term favorable for private equity. And I don't mean to paint everything with the same brush. There's certainly some areas that could do well if we have tighter credit, and there are some issues in real estate. Some of the debt funds may be able to buy assets on the cheap, but in general, we have not focused on private equity. There's a question here on geopolitical risk. There's an old adage, don't poke the bear. So wondering about risks as it relates to Russia and Ukraine. Look, that there's always ongoing conflict, and there are positives and negatives. You know, I don't like to say we're trying to profiteer on the back of conflict, but certainly it has not been terrible for the defense stocks. You know, it's probably not a negative thing for some commodities, and there are risks, and you have to assess them. We think that the market is like a giant machine of 1,000 moving parts, and all of those parts contribute to the price action that you see in the market. And in general, the price action has been quite constructive. So as long as the sectors we're focused on are performing the way they should be, given the fundamental data that we have, we try not to get too fussed about the geopolitical risks unless they start showing up in the market. And at this point, you know, really not the case. A question on Japan. Frankly, I think Japan looks just fine. Bull markets are marked by short, sharp corrections. The question is, how resilient are they? And in that shock that we saw in Japan, it bounced ferociously, you know, down up 10% the next day. So I continue to be bullish on Japan, and certainly we think that some of the technical factors led to that sell-off, but it will be important to see how things go from here. Bullish percent, or the percent of stocks in uptrends, turn right back positive in Japan. So I do think it's interesting that Warren Buffett stepped in quite quickly to buy Japanese shares. Inflation is what they've been looking for. The fact that they've got some inflation, I think, is quite a positive thing. I think that's all the questions. I really appreciate everybody signing in. We are likely to see less liquid markets over the next couple of weeks. So, you know, we're just going to follow our discipline. I like the fact that industrials and financials and energy is hanging in quite well. Really like the way that the golds are behaving. So there are things to do. And should we see some of the sector work get a little bit better, or the market breadth data get a little bit better, we can start putting a little bit of cash back to work. But having a little bit of cash is not a terrible thing either. So if you've got questions we didn't answer, please don't hesitate to give us a call or reach out via email or through our website. If you'd like to subscribe to some of the things that we write, please go to the website and subscribe. And if you've got questions about your portfolios that we didn't answer, don't hesitate to reach out. We got time. August is a quiet time. Lots of people are away, but we have time to talk. So thanks very much for tuning in, and we'll see you again next week.